One of the reasons I started this channel was for teachable moments like this. Welcome to Get Invested, where it's not just about growing our wealth, it's about growing and improving ourselves. I'm sharing how I build market-beating stock portfolios using a growth-focused mindset, starting with just $100. I invested $100 on July 1st of this year, and I'm continuing to invest another $100 each week since. I share my trades here on the channel with a little bit of my thinking and rationale along the way. I include direct links to my portfolio in the video description below. If any of that sounds interesting to you, hit the like and subscribe button. It really helps out a new channel like this one. Let's get started. We're building a growth stock portfolio. By that, I mean a portfolio comprised of individual stocks of companies that I believe will increase their revenue and market share substantially over the next 3 to 5 years. If these companies are successful in growing their business, their stock prices will go up, which in turn will increase the value of our investment. Some viewers will wonder why I'm buying individual stocks instead of ETFs, also known as exchange-traded funds. Please watch my first video on why ETFs aren't performing the way you think they are. I'll put a link in the description below. In short, ETFs made more sense 20 years ago when there were high commission fees on each trade and it cost $15 to get a quarterly report mailed to you. But now that we have the internet, zero commission fees, and stock screeners, you can outperform most ETFs with just an hour or two of online research. I'm making this portfolio public so viewers and new investors alike can see exactly what I'm talking about. To date, we've invested $400 spread across 11 companies in industries like technology, consumer products and services, healthcare, and automotive, specifically electric vehicles. I chose to focus on these industries first because they were growing before the COVID-19 pandemic swept across the world, and they seem to have recovered the quickest, which gives hints that they will likely continue to grow once the pandemic eventually passes. In tech, we have companies such as Google, C Limited, which is an e-commerce and cloud platform in Southeast Asia, Apple, Amazon, and Zoom. Of our technology companies, so far we've seen the best performance from Alphabet and Amazon. In just 1 month, both companies have done 8 and 9% growth, which is incredible. Zoom and C Limited have been relatively flat. Tech has been hot the last few months, and so we bought these right at their all-time highs, so I'm not surprised if they're going to dip down a little before we see them climb up again in the future. Then, in consumer products and services, Netflix actually missed their revenue targets, causing the stock to drop significantly 2 weeks after our initial purchase. So the fact that we're up at all is a good sign. The company's year-over-year revenue grew by almost 25%, so I don't think they performed poorly. Instead, I think Wall Street and investors just had really high hopes of increased revenue during a period when people were stuck at home, likely looking for entertainment. But remember, Netflix is a subscription company, and they've probably already maximized most of their US subscriptions, so I think Wall Street set an unfair expectation on the business. On the other hand, we have McCormick, the food and spice distributor. It's up 9% since our initial purchase. Generally, our portfolio is heavily tech-based. It's the industry I'm most familiar with and one that has the highest concentration of growth stocks because tech scales rapidly. So why do we own a spice distributor? Well, if you've been following the channel, you know we added this stock as a bit of a hedge in case the US went back into lockdowns. When on lockdown, people cook at home more often, and that's an environment that McCormick thrives in. As we see coronavirus cases are now going back up in the US, it's no surprise that interest in McCormick stock is increasing as well. It's nice to see examples of our theories paying off in increased stock returns. Now in healthcare, we have Teladoc, a leading telemedicine provider, and Quidel, a medical testing service company. Both have been trading at their all-time highs when we purchased them. So the type of sideways movement we're seeing now is to be expected until we receive more news on their earnings or major updates on vaccine production, which will further boost the healthcare industry. Last but not least, our most speculative and thus most volatile stocks in the portfolio, Tesla and NIO. Electric vehicles are still a very new market, and for that reason, it's still considered risky, and rightfully so. Investors are waiting to see if these companies can establish themselves as long-term market leaders. Until that's proven, we're going to see a lot of ups and downs with these two. For example, NIO dropped 25% a few days after we made our investment when a Goldman Sachs analyst in China downgraded the stock. NIO is a Chinese company, and US investors are already a little tentative about owning it, so any negative news has a very high probability of lowering the stock price. A separate downgrade on Tesla scared investors and caused both stocks to drop last week too. They're starting to claw their way back, but these two are currently down quite a bit compared to the rest of the companies in our portfolio. Let's take a look at the impact that has when we look at a return trend chart compared to the S&P and NASDAQ. What this is showing is our portfolio percentage return since starting the channel. This would be episode 1, starting from scratch. Episode 2, we finally have invested money and we're seeing a 9.06 return. This is where we're beating the market from our first week. Episode 3, things dip down a little, 7.74% return. Episode 4, this is our 10.24% return, performed solidly well beyond the NASDAQ and the Dow. And then you can see this week's current performance. We went from 10.24% all the way down to 2.3%. So what happened right here? How did we go from 10.24% to 2.23%, losing 8 percentage points in just a week? Well, there was a tech sell-off last week. By that I mean many institutional investors sold a lot of their tech stocks while they were at their all-time highs in an attempt to lock in some profits. This is very typical, and what happens is that those same investors will come back in and buy up the tech stocks again in a few weeks or a month from now, pushing those prices back up. So this tech dip is only temporary. That same action coincided with NIO and Tesla's downgrade, which brought the returns from our portfolio down quite a bit in that time. So we are still up and in the positive. We have not lost any money. We're up 2.23%, which is still great performance in just a month. But we are performing under the market right now, which is under our goal and our target that we set for this portfolio. So how are we going to remedy this going forward? One of the reasons I started this channel was for moments like this. I wanted to create an opportunity for future me to be able to look back at my decision making and see whether it was sound. Was I properly thinking strategically based on the current context, and how does that play out? So let's talk about our current options at this point in time. I'll try and chart them out from worst to best, as I probably used to think of them when I was new to investing. When I was brand new to investing, I would have had the bright idea to sell these stocks right now while they're down with the hopes of repurchasing them at some point once they're at a lower cost basis. And yeah, in theory, that could work. However, there are several pitfalls that are very easy to fall into if you take that approach. 1, if we sell now, guess what? We're locking in our losses. We are literally buying high and selling low. That is how you lose money in the stock market. Also, if our plan is to re-enter these stocks at lower prices, what do we do if they go up tomorrow, and then the next day, and then the next day, and they never fall back down to these levels? Then we would have wished we held on to the stock, because getting back into it's going to be more expensive than we're in it now. Alternatively, if we want to lower the impact that these stocks have on the rest of our portfolio, we could just buy more of the other companies with this week's investment. Remember, we're putting another $100 in this week, and we could focus that just on growing our technology, consumer, and health portions of our portfolio, leaving automotive the same. Doing so will increase the percentage of the other stocks and lower the percentage of these highly volatile automotive stocks, reducing our relative exposure to that risk. Another option is we can actually buy more of that automotive stock. I'm not going to call this doubling down, but instead I'm going to say these stocks were a good deal last week when we purchased them. So if they're now 5% less, I view that as a 5% discount on the purchase. And anytime I see something that I was originally going to purchase is now 5% on sale, even better for me. So what we're going to do is a mix of 2 and 3. As it stands, our technology pie, which has been performing the best so far, now takes up 41% of our portfolio. So I don't think it makes sense to reinvest in those at this time. They're already doing well enough. But I think there is some opportunity to buy more of our consumer pie. Remember, Netflix is still down, even though we expect them to perform significantly better. And our healthcare stocks, which are currently trading sideways. So what we're going to do is we're going to put $25 into our consumer pie, $25 in our healthcare pie, and $50 into our automotive pie. This will allow us to buy in significantly while these automotive stocks are at a discount. But in the future, we won't be investing them as aggressively. Let's let some of that speculative volatility work in our favor. So let's see what that looks like. We've got $25 in our consumer pie, $25 in our healthcare pie, and $50 queued up in our automotive pie. So we'll be purchasing more of Tesla, Quidel, Netflix, NEO, and McCormick. Trades are queued up, and they'll execute first thing with market open. That's it for this episode. We'll check back in next week. If you found this video interesting, hit the like button. Also, feel free to share your thoughts in the comments. If you want to join us on this investing adventure, hit the subscribe button. We'd love to have you. Links to this episode's portfolio are in the description below. And if you want to get notified each time we add a new video or new stocks, make sure to hit that notification bell. Thanks a lot. Have a good week. Stay safe and get invested.